Dollar-weighted basis, dividends are up well over 50% because we saw some massive dividends from the likes of BHP and Rio, and BHP also paid a special in January. So there's a huge amount of cash floating around to investors, and that special dividend from BHP was almost worth a full year of dividends. It amounted to $7 billion with another $3 billion of franking credits. So there's a huge amount of money coming out. On top of that, we've got some buybacks. Caltex is doing a buyback, and Woolworths announced that they would be doing a tax-effective buyback, which we had been predicting for a while, of $1.7 billion. So another $1.7 billion plus franking to come out of Woolworths in the next couple of months. In terms of the makeup of of where the big dividends are coming from, it's largely from the resource sector for a couple of reasons. One, they've got solid earnings. We're seeing supply side issues there. So for iron ore prices are staying high because of problems with some of the Vale mines in Brazil, but you're also seeing fairly strong price rises, and they've got good capital discipline. They're not actually spending their profits in new mines, they're actually returning it to shareholders. So that's why it's concentrated in the resources, where some of the other sectors are doing it tough, retailers. The banks haven't actually increased their dividends for some time, and Telstra actually cut its dividends. But it's actually nice that resources are showing, leading the way in terms of dividend increases. Another little fillip for investors is that Westpac announced that it would bring forward the payment of its interim dividend this year. Normally they pay them in July. They're going to bring that forward and pay it in June. So again, that's another little sort of early present for investors if they're investors in Westpac, and they'll be able to get their franking a year earlier if they can use that franking. So we do see some more, although I think the biggest impact of dividends would be in the first quarter, because that's when most companies report, but we'll still see a fairly solid second quarter as well. In terms of interest rates, we saw confirmation in March that the RBA's actually officially moved to neutral bias, but the market itself is actually now well ahead of that. They're actually factoring in by the end of March 2 rate cuts this year is what's built into the curve. At the same time, we saw the Fed formally announce that they're actually on pause as well. So we won't expect to see any more interest rate rises in the US or Australia anytime soon. And so the market is predicting that there's likely to be 1 or 2 cuts this calendar year in Australia. The PL8 portfolio performed very strongly over the first quarter. The market itself was up 10%. We were up a bit more than that. So it was a very strong quarter and completely erased the falls of the December quarter. So it's back to normal as I think people have priced in lower interest rates. That's been reflective in increased capital values across the market. Thanks for listening today. For further information, please go to our website at www.plato.com.au.